Hello, everyone. Welcome back to another episode of Advisor Insider, powered by ETF.com. I'm your host, Jeff Benjamin, Wealth Management Editor here at ETF.com. And today we're talking commodities. We've got Kathy Kriske, Commodities and Digital Assets ETF Strategist at Invesco. She's an expert in this space. I spoke with her recently, and I was so impressed with her knowledge and insights and perspectives that I said, we got to get you on here and explain this to the people because I couldn't possibly do justice to what Kathy had to say by writing it all myself. So we have Kathy. We're fortunate to have Kathy. Kathy, how you doing?
I'm great. Thanks so much for that intro, Jeff.
Yeah, well, thanks for being here. I know I didn't set the bar too high because I know how smart you are on this space, but let's let's start with kind of a general outlook for commodities. What does it look like from your perspective?
So I would love to say that commodities are just going to have a straight line up, but these are turbulent times, right? And the path for commodities is mixed. So I always start with commodities are volatile, right? So you should never go all in with this asset class. Like that's just my blanket disclaimer.
Hmm.
But they do serve an important purpose in that group of alternative investments, like the real assets. And I think like sort of just telling a story of what happened like in 2021 and 2022, commodities literally saved many investors. We spoke to some people that said that they shifted away from their traditional 60-40 breakdown. And by adding just a 5% commodity allocation, it shifted their returns from what would have been minus 30 to plus 5. So they beat their peers, right? So that's why it's really important to understand where we shine. But so in terms of outlook, that we look at a few characteristics. One, geopolitics. Okay, and I'm going to come and do some details about that, but also fundamentals like supply and demand, global macro, the weather, and just being ready for some of those unknown unknowns, like to quote Donald Rumsfeld, right? The things that are not even on our whiteboard, right? So,
Hmm.
in terms of geopolitical risk, we have two active wars in commodity resource regions, right? Obviously, Russia, Ukraine, and the Middle East. And currently, there's a risk premium from the geopolitical, like escalation that goes into some of these commodity prices. So a lot of investors will start a call with me saying, Kathy, why isn't oil at $100? And I point out that even though we have these active wars, like we haven't actually lost barrels from the market. So, but the Russia and Iran are still producing and selling their crude oil, but we could have problems ahead. And that's why I'd say, Trump 2.0 may have a bigger impact on geopolitics, especially from the increasing tensions with Iran. And if Trump chooses to do what he did last time with this imposing maximum pressure campaign on Iran, that could escalate very fast, like starting enforcing these oil sanctions. Now, these sanctions have been in place for years, but they were not being enforced. So Iran has been selling a great deal of oil to Asia at a bargain price. But if this were to shut down, we would see a rise in price, the price of oil really fast. OPEC might be able to offset that, but that's a really big geopolitical risk just
Hmm.
in the background, right? But in terms of supply and demand, we need to watch China, right? Demand out of China. China is the biggest buyer of commodities, and they have been working hard to have put in stimulus measures. But we need very real stimulus measures so that this demand comes back. And on the macro, one of the big things is tariffs, right? This idea that we might have tariffs imposed and there be retaliation. So this could cause some problems for like, industrial metals and grains. But another factor, weather. Right, we are all seeing this extreme weather, and this impacts like agriculture, like the grains and the soft commodities like cocoa, coffee, and sugar, natural gas, and heating oil. So, in summary of all this, like what is my general outlook on
Hmm.
commodities? I would say energy, geopolitics could be bullish, but fundamentals are potentially bearish. Industrial metals, like the energy transition is bullish, but tariff retaliation could potentially be bearish. Whereas precious metals, like I have a hard time finding bearish side to that, but we have this de-dollarization. Central banks are trying to move away from U.S. Dollar treasuries and other assets, and they're de-dollarizing, and they're doing that with gold, right? So we have a big bid under gold, and also Fed easing, right? So the Fed is lowering interest rates. That is, those two factors are really good for precious metals, both gold and silver. And this agriculture, Right now, the grains are oversupplied, things like corn and soybeans, but weather can change that very, very quickly. And the soft commodities remain tight. We don't have enough of them, and weather has already impacted that. So we could see a strong 2025. I know that was a
Hmm.
lot, Jeff. Sorry about that, but
No, it was. It was a good kind of a background or a good foundation. I was frantically trying to take notes and keep up, but all right. Most investors, even professionals like financial advisors, are not buying commodities directly. Nobody's got, a big pile of coal sitting in their backyard or anything like that. Um, they're buying through funds, ETFs. What do investors need to know about buying commodities in an ETF or a commodities ETF?
I love that question. And I'm going to have to mention two words that sometimes make investors feel uncomfortable, but I will explain them: contango and backwardation, right? And so when people say just what's the simplest way to remember them for commodity investors, when you're in school, you'd much rather get a B on your report card than a C. So I want you to think like backwardation, great, right?
Mm,
And contango, bad, right? You come home with a report card with a C on it, your parents are not happy, right? So what are these two things? Backwardation signifies scarcity, right? So that means it's the shape of the commodity futures curve, and it means that prices are high right now. And then they're not so worried about the commodity over time, so the prices go down over time, right? Contango is the reverse. It's like going up a hill where the prices are low right now, and over
hmm
time they're going higher. So contango signifies a surplus, right? Think shale revolution, right? Where we had so much oil and we had that drill baby drill, loads of the commodity on the market, right? So why is
hmm
this important for investors? Well, it's different for investors that buy things other than gold. Gold is physically backed. Most of the gold ETFs physically backed. There's actually real gold in a vault, right? But when you do other commodities that are harder to store, right, you use a commodity index that references these commodity futures, right? So that references most of them, the traditional ones reference that front month contract, right? Someone says, "Oh, what's the price of oil?" And they're like, "Oh, WTI is at $70." That's the front month futures contract. That's not actually the price for the physical oil in the barrel, right? So the reason why this is important is, as I said, these indices reference that front month. Well, every month those indices have to roll those futures contracts, right? So if you're
hmm
selling at 70 right now and it's going it's in backwardation, you're selling at 70, you might be buying at 68. You're like, woohoo, every month it rolls, I'm making money in a backwardated market. It's called positive roll yield. But the
hmm
reverse is true in a contango market. Right now, let's use that example, like the oil's at like 60 and the next contract's at 62. Now you're selling at 60, buying at 62, right? We know from investing, you don't want to, sell low, buy high, right? This is bad. So this is negative roll yield. And like just to hammer it home, I was years ago, I think it was 2006. I had an investor call. I was like, Kathy, I bought commodities. They went up, yet my return is exactly zero. Like, please explain that to me. I said, well, dude, these markets are in contango. There's this negative roll yield as you're rolling up the curve. He said, well, I don't want to roll. What happens if I don't roll? I said,
hmm
well, where do I deliver the lean hogs and the live cattle? Like, do you have a big
Yeah.
swimming pool for all this crude oil? And he's like, oh, I
hmm
get it. So I said, so that's why this stuff is important. But that's why where in Invesco, our main product, this product PDBC, and it's a Papa Delta Bravo Charlie, right? Which actually stands for, that's the ticker for the Invesco Optimum Yield Diversified Commodity Strategy No K1 ETF, which I know is a mouthful. That's hence we just lead with the ticker PDBC. But when this was the index that this uses, it's called optimum yield because they know that if the markets are in contango, we want to be far out the curve, right? So say we have this really, like going up that hill and we have the drag, this index can go out 13 months. So you not only don't have to roll every month because you're holding something that's not going to expire for 13 months, but also we tend to look at that slope of the curve and try and be at the point where you mitigate as much of that, contango stuff, the bad stuff, and then you maximize the backwardation. Like, so, right now, both the crudes, WTI and Brent, are in backwardation, right? So our index is towards the front of the curve. And so again, I know those words, backwardation, contango, make investors nervous, but that's why you need to look at the index and see, does it do this like curve hunting? Does it try and be at the right place along the curve? right? And it really does make a big difference. So, a great example in April 2020, crude oil went negative, WTI went negative, right? And so not only was the index far out the curve, but we also, our product, PDBC, is actively managed. So they were even further out the curve. So whereas all the other indices were crashing as we saw negative prices, our investors were sort of protected from that because we were really far out the curve. And just on that active management thing, I also think that's an important factor that commodity investors should look for. Our,
Mm-hmm.
our commodity PMs are experts in their field of commodities, right? So they're not just creating a formula and sticking to a formula, right? They are really researching this. They're in the weeds every single day, looking for opportunities and where to be along that curve and how to like do relative value trades, overweight one commodity versus another commodity. So I think those two factors, again, the complicated contango and backwardation, but also the active versus passive management, really important.
Is now a good time to be in commodities at this point in the cycle?
So a lot of people talk about like a commodity super cycle. And while we were, as I said, great in 21, 22 and half of 2023, but this year we're sort of like flat on commodities. So I am a big fan of buying the dip, right? When you see things that are not racing up. And as I led with, commodities are volatile. So I say to people,
Mm-hmm.
like, if you decide you want commodities for whatever reason, there will be a dip, right? We are going to have a dip, like even gold, right? So gold was rushing up, right? And we recently had a dip. But if you think about why you might want commodities, right? I always say basically three reasons. You want an inflation, it's good for an inflation hedge. It's actually the most efficient inflation hedge. Two, diversification. And then three, plain and simple returns, right? So on the inflation side, again, some of the investors listening to this might say, oh, we got this inflation. We're done with inflation. The Fed beat inflation. We're all done. So I would just say, keep an open mind, right? There are a lot of things that could be happening over 2025, 2026 that could be very inflationary, like tariffs, like even just improving economic situation. People have more money to spend. They're going to spend that money, and that leads to inflation. Large tax cuts, right? Or things we're not even thinking of. Again, those unknown unknowns. So I am in the camp of I don't think inflation's over. I think that in the next few years, we're going to see higher inflation. As I said, that's where commodities shine, right? We are a great hedge for
Mm-hmm.
inflation. But then diversification, right? We're negatively correlated to fixed income, and we have a very low correlation to equities. So again, for that example that I raised with the guy who didn't do 60/40, he's like, yeah, I put in my 5% and it saved me. So I think that diversification is really important. And so that's why I think like it, the whole idea, is it a good time to buy commodities? If you think one, we could have inflation. Yes. Two, you want some diversification. Against, I know equities have been on a tear, but sometimes they don't just go up, right? And that's where we shine. And then
Mm-hmm.
lastly, returns, right? We all want to make money on what we invest in. And so I do believe that there are some factors that are going to be long term good for commodities, right? This energy transition using so much industrial metals, right? One of the other things that I believe in, and this is sort of big picture, is we looked at Fed easing. And historically, believe it or not, Fed easing, so Fed lowering rates, historically has been good for commodities. The one caveat is not when we have a deep recession. Okay, so recessions are terrible for commodities. So if you believe in your heart that we are going to have a recession in the near future, like you can turn this off right now, right? Because commodities will not save you in times of a recession. It's like, but if you believe that, we are probably going to not have a recession, and I'm in that camp, I think commodities should be great. But with the Fed easing, when we went back in history, one of the things I thought was so interesting was 1995 and what happened then. I know it was long ago, but it's a really interesting year and I actually wrote a headline like commodities are going to party like it's 1995, right? Just
Mm-hmm.
to honor Prince, but with a different year. And so what happened back then is the Fed eased, but not because we had a deep recession or we had massive unemployment. We just had slowing GDP growth. So that sounds exactly like what we're going through now and why the Fed is again starting to ease. So what happened in 1995? Well, within 2 months, we were up about 2%. Within 6 months, we were up about 14%. And then within 9 months, commodities were up 32%. So I know that may sound a little crazy to look all the way back to 1995, but it is, again, one of the most similar times to now. So again, when you ask that question, is now a good time to hold commodities? I want to say, in my view, investors should always have a small allocation of commodities, right? For that just in case. And that's why we say 5% like helps deal with that inflation, gives you the diversification. And again, is it that it's a great hedge for those unknown unknowns?
Okay. Final question here. What would you say is the best way to get exposure to commodities? There are commodity ETFs that have diversified portfolios, and there are a lot of single commodity
Yes.
ETFs. What should investors do? If you go single, are you making a bigger bet on one commodity?
Yes. So, and again, I every investor has to follow what their belief system, right? And but as you wouldn't invest in one stock, you shouldn't invest in one commodity. And I know it's so tempting, right? And I look back until when we had the Russian invasion of Ukraine, wheat went nuts, but everybody chased it higher. And that's another thing. Commodities are volatile, like I said now for the third time. So they will usually come to your price. So be disciplined in commodities and buy those dips. So again, one of the things I would say is, like you wouldn't go for one stock, don't go for one commodity, but go for broad based. So that's right. Like our products, not just PDBC, the one I already mentioned, but we have DBC, which is a little bit different. It's not actively managed, but the same index. But we cover those three areas. We have energy, we have metals, including industrial and precious, and we have agriculture, right? So broad based, I think makes sense. But also we do have those single commodities. We have DB which is just oil, just WTI. And that's for those clients who just want to bet on oil. But again, it's exactly that. It's a bet rather than an investment. So I know we want to like buy the shiny thing, and like gold's been the shiny thing literally for this past year, but it is a little bit more concentrated risk. So that's why I'd say, like, if you remember nothing from what I've said, it's like, one, commodities are volatile, but they are a great hedge for inflation and a diversifier, and it's best to go broad based. So that's my
All
belief, and
right.
I'm sticking with it, Jeff.
That's really good stuff. Very helpful. Good education and insights on commodities. Don't be afraid to get out there and invest in commodities. Get your sleeves rolled up and watch out for contango and backwardation now that we all understand it. I want to thank Kathy Kriske, Commodities and Digital Assets ETF Strategist at Invesco. I'm Jeff Benjamin, and this is Advisor Insider, powered by ETF.com. Don't forget to go check out ETF.com, especially the Advisor Center. We've got a lot of tools there. We've got a lot of news and a lot of information. If you're trying to reach me, my email is jeff.benjamin@etf.com. Thank you very much, and talk to you next time.